Exercise 21-31. We're going to use the contribution margin ratio to predict income. So here's what we're going to do. We're going to calculate the contribution margin ratio. And then we're going to use that contribution margin ratio to tell management what would the operating income be if we had sales of $250,000. And also, what would our operating income be if we had sales of $360,000? So we're doing two what-if scenarios. What if sales was $250,000? What if it was $360,000? And then notice here it says, Global's relevant range is between $250,000 and $360,000. So what that means is, as long as our sales are between these two numbers, then the fixed cost will stay the same. All right. For its top managers, Global Travel formats its income statement as follows. So notice this is a contribution margin income statement. So that means this is an income statement that people internal to the company, the managers, would use. Notice the formula: sales revenue minus variable costs equals contribution margin minus fixed costs equals our operating income. All right, so the first thing we need to do is calculate the contribution margin ratio. We're going to select the labels and enter the amounts to calculate the contribution margin ratio. Enter it as a whole percentage. So if we get down here and we have to round, if we get like a 23.1, then that becomes 23%. So the formula for contribution margin ratio is right here. Contribution margin divided by sales revenue. Contribution margin divided by our sales revenue. So now we're just going to take the actual numbers. Contribution margin is $207,025 divided by net sales revenue of $318,500. Copy and paste. Now we get to crunch the numbers. So 207,025 divided by 318,500 gives us 0.65. We multiply that by 100 to convert it to a percentage. Because they have the percentage sign, that tells us we know we need to convert it to a percentage sign. And the way I converted this to a percentage sign is I just multiplied by 100, and that gives us 65%. So what that means is that for every dollar of sales revenue, we get 65 cents of contribution margin. Now we're going to prepare the first contribution margin, and we're going to assume our sales are going to be 250,000. So this is our first what if scenario. What if we have sales of only $250,000? The way we use a contribution margin, remember the contribution margin means of this amount of sales revenue, we get this much of contribution margin. So in other words, 65% of the sales is going to be contribution margin. So to calculate that, we go 250,000 times 0.65 equals 162,500. So that is our contribution margin. Now, how do we get variable costs? Well, we kind of back into it. The way you would normally calculate the contribution margin would be 250,000 minus variable costs gives us our contribution margin. So we're going to go backwards. We're going to take 250,000 minus 162,500, which will give us our variable costs. So 250,000. We're going to subtract 162,500, which gives us 87,500. Now, there is another way to calculate the variable costs. If the contribution margin is 65%, then that means the variable costs have to be the complement of 65%. And what complement means is to calculate the complement of 65%, you take 100% and subtract 65%. So 100% minus 65% gives us 35%. So we could have calculated this 87,500 by taking the sales revenue and multiplying it by 35%. So I'll show that to you. 250,000 times 0.35, again, that's the complement of 65%, gives us 87,500. So what this means, what this format is telling us, is that if contribution margin is 65% of sales revenue, then this 87,500 must be 35% of that. Okay, now we have our fixed costs, and our fixed costs are still going to be the same. Over here, they're 175,000. Copy that, paste it, scroll down. So it looks like we're going to have a loss. So to calculate operating income, you take 162,500. Then we're going to subtract this 175,000, which gives us negative 12,500. I guess I could have just used this to plop it in there. So notice it tells us use a minus sign or a parentheses for a loss. I do a minus sign because it's only one keystroke. If you do parentheses, it's actually 4 keystrokes. Shift plus the open bracket and then shift plus the closing bracket. So that's more chance for error. All right, so our next what if scenario is what if well, let's just back up a second. So these were our actual numbers over here. Sales revenue on 318,500 gives us operating income of 32,025. So management has asked us, well, what if sales revenue drops to 250,000? What will our operating income be? And you say, we don't have any operating income, we have operating loss, 12,500. Now the next scenario is, well, instead of 318,500, what if our sales increase to 360,000? So I'm going to plop in 360,000. And there's 2 ways to do this. Contribution margin, remember that was 65%, which we calculated right here. Means 65% of net sales revenue turns out to be contribution margin. So we can take 360,000 times 0.65, which gives us 234,000. And then we can back into our variable cost by taking 360,000 minus 234,000. So 360,000 subtract 234,000 gives us 126,000. We could have also multiplied 360,000 by the complement of 0.65, in other words, 65%. And the complement of 65% is 35%. So 126,000 is also 35% of this. Let's just check that just to be sure, or just to prove it to you. 360,000 times 0.35. It might give us something that's a penny off or so. So 125,999 and 99.99999 cents. That rounds to 126,000. All right, fixed costs are still going to be the same, 175,000. And then to get operating income, we're going to take 234,000 minus 175,000. So 234,000 minus 175,000 gives us 59,000 of operating income. So this contribution margin ratio, which is pretty easy to calculate, comes in very handy in trying to predict future income depending on our various levels of sale. In this case, $250,000 and then 360,000. Trust me, when you can do this for a manager, they'll think you're a math whiz.